Hi friends, so today we're going to talk about merchandising. So I know what you've got to be thinking. Where's Miss Yin? I know. It's been a long time since we've seen her. So we're definitely going to check in with her today. But she's been super busy building her business and building everything out. And I can't wait to show you what she's been working on. But for right now, we're going to talk about merchandising operations. So, not to be confused with manufacturing, which is totally a separate subject that is covered during the managerial process in accounting, which is accounting like 102. But today we're going to talk about merchandising. So, merchandising is basically just selling and buying goods. So you're selling a good completely whole and ready to go, and then you're reselling that good. So you're either a wholesaler, which is like you're selling from one business to another, or you're a retailer, which is selling to the consumer. All right. And so as I stated before, the cycle is just very cyclical. All you do is you purchase something. Hopefully you're selling it at a profit. All right. You're making some money off of this, and then you're selling it for a profit. Then you're using your profit to reinvest in your building and buy some more. Reinvest in your business and buying some more. Okay. So that's a merchandising company. All right. So some accounting things that are associated with this merchandising company is, first, on our balance sheet, we now have an account called inventory. Sometimes you may see it listed as merchandising inventory because when you get into manufacturing, inventory gets a little more complicated, as you can imagine. But once again, we're not going there today. All right. So you have a new inventory account, which is an asset. Right? You're purchasing these things for selling them later. This is a benefit to your company, so it's an asset. And then on the income statement, the old way that we used to show information was we'd have revenue minus expenses equal our net income. Now we have net sales minus cost of goods sold equals gross profit. Okay, so we're going to talk a lot more about that in a little bit here, but I did want to start there by making that distinction. Okay. All right. So there are two types of inventory systems. We have the perpetual inventory system, which means we are perpetually, is that a word? We're continuously keeping track of our inventory, okay? Whenever we sell something, it's automatically recorded. Whenever we buy something, it's automatically recorded. It's always up to date. We're always updating this. A great example of a perpetual inventory system is like a grocery store. That little scanner at the checkout line, the reason that's important is because it's providing up-to-date inventory information so that the stores will know when they run out of things. Okay, the other inventory system is called a periodic inventory system, which says we don't have the capacity, we don't have the money to keep up with this stuff right now. So we're going to keep up with it at the end of the period, end of the month, end of the 6 months, 3 months, or possibly at the end of the year. I do not recommend that because you always want to know what's in your inventory. All right, being honest, most companies have moved away from a periodic inventory system because it's so easy to keep up with it online. For the purposes of accounting and learning accounting, we always learn the historical basis. So we're going to talk about the periodic system, even though, like I said, most people are on the perpetual system now. All right, so Miss Yin. Miss Yin. So Miss Yin, I don't think we talked about it. Miss Yin has decided that she's going to sell jewelry. Okay, so Miss Yin is always completely fly in all of her nice jewelry. So she decided that she was going to make it available to the public. All right, she's going to do this in a completely e-commerce site, which basically says she's selling online. She's not opening up a brick and mortar, a business just yet. She's going to do everything online. The name of her company, get this, is going to be Yin's Yangs. I like that, right? She did too. All right. So for the purposes of what we're talking about today, her inventory is going to be her jewelry. She's going to be purchasing her jewelry from a wholesaler and then selling it back to the public, to the customers. And so she's going to be a reseller. Okay. And of course, she's going to use the perpetual inventory system. She's going to use this system so that her inventory numbers stay up to date at all times. All right. And so just really quickly, I want to take a moment and kind of show you some of Miss Yin's Yangs and take you to her website, which, I mean, the stuff is still coming in, so nothing's in stock right now, but it gives you an idea of the things that she's about to be selling, okay? So as you see now, we have about 8 pieces that are listed on the website, and they're super cute. So Miss Yin, as she has acquired these things, she has a cost associated with that. That cost is now sitting in her inventory account as an asset. So we're not treating it as an expense. This is an asset for her business. All right. So nice. All right. So let's get down to business. So in a merchandising inventory system, you will have things like purchases and sales. Basically, short and sweet. You're going to be purchasing things, you're going to be selling things, and then that's it. All right. So whenever you make a purchase, you're going to debit your merchandising inventory account because you're going to increase your assets. Remember, we debit our assets to increase them. All right. So you're going to increase your asset with a debit, and then you're going to credit either cash or accounts payable. All right. So either you're going to pay cash straight out or you're going to do an IOU, like I'll pay you later. All right. And then once you pay it, if you do it on credit, then you're going to debit your accounts payable and you're going to credit cash. All right. So there are other situations. Sometimes you pay for things on credit and they give you like these weird terms, but it's basically like a way for them to encourage you to pay earlier. That is called the credit terms, and that's when we pay to get a cash discount. So for example, you'll see that we have this little thing called 210 in 30. That means 2% if we pay within 10 days, but if not, we need to pay it within 30 days. So we get a 2% discount if we pay within 10 days. If not, then we have to pay it in 30 days regardless. Okay. All right. So if that is the case and we pay within those 10 days, then we get to record a discount. So instead of having to pay the full amount of the payable of the money we owe, we get to discount that. So we get to split our cash amount between the cash amount, and then we credit merchandise inventory, which is representative of that discount. Yes. So it's always encouraged that you take full advantage of any discounts that are available to you because duh, who doesn't like to save money, right? All right. So then the other side of that is we have some sales. Anytime you have a sale, if you're a merchandiser, if you're a business and you're selling a product, you will always have 2 parts to your journal entry. All right. 2 parts for the sale transaction. The first sales transaction is going to be a debit to accounts receivable or cash and a credit to sales. This is going to be for the amount of the sale, what you sold it for. I sold this piece of jewelry for $15. That is going to be the $15 that I do in the first part of this sales journal entry. The second part is we need to reduce our inventory, right? We don't want it to look like we have $100 worth of inventory when we actually have already sold some of it. So we need to go ahead and reduce our inventory. All right, so we're going to debit cost of goods sold, which is an expense account that's going to go on our income statement. And then we're going to credit merchandise inventory, bringing that asset down, decreasing the asset. Now this part, if we sold it for $15, but it cost us $10, the $10 is going to go in this part of the journal entry. Okay. And then finally, when we collect the money from our customer, we're going to debit cash because they're going to pay us with cash. And we're going to credit accounts receivable because we need to get it out of their account. They no longer owe us that money. That is without a discount. In the event that we offer our people a discount for shopping with us. Now remember, before we were talking about purchasing. We were the people trying to get the discount. Now we're on the sales side where our people are the ones trying to get this discount. All right. So if they pay us back, we do the same terms, 210 net 30. That's 2% within 10 days, or they have to pay within 30 days regardless. If they meet that requirement, then instead we're going to debit cash and we're going to credit accounts receivable for the full amount. And I'm sorry, there's a mistake here because that's supposed to be a debit to cash, a debit to sales discount, and a credit to accounts receivable. And the reason I know that is because we always have to credit accounts receivable for the full amount of the transaction. So we have to fully take their money out of the accounts receivable account. All right, friends, we are back. And as you can see, I did go ahead and make that change on the screen because I couldn't do you like that. I couldn't have that mistake out there for you to remember and just, get it wrong. All right, so moving on. All right, so we went through the sales, we went through the purchasing. The next thing is for those people who do a periodic inventory, even for perpetual inventory folks, we have to do a physical comparison, right? If you've ever worked at like a grocery store and retail in general, there's probably been a period of time where you had to close the store early for like inventory, which really included you literally going out into the floor and counting everything hand by hand. The reason why is the downside to a perpetual inventory system is that you're going solely based off of what's been sold and what's been purchased. What if things go bad, like milk spoils, bread spoils? If you have like a person who likes to take extra things home that they're not supposed to, well, those things never get counted unless you do a physical count. So we call that shrinkage. So if there's a situation where for whatever reason things have expired, somebody has developed some very sticky fingers, whatever the case is, we have to account for that at some point. And the way we do that is once we do a physical count, if there's something been damaged, lost, or stolen, whatever the case is, then we have to debit cost of goods sold, so that expense it, and then credit inventory. We have to get it out of our inventory account, okay? We can't say that we have 100 units of a product if we only have 97. All right? Now, for the fun part, we're going to get into some entries that Miss Yin has encountered in her business. All right? So, she has already been selling goods. The website I showed you earlier has sold out. She's sold some goods. All right. So, this is like a little recap of some things that have already happened for Miss Yin. All right, let's go through them. On March 1st, she purchased $2,000 of inventory on an account from ABC Company with credit terms 210 net 30 at FOB shipping point. Freight on board shipping point. It means that when it ships, that's when it changes possession. If it was FOB destination, it changes possession at the destination. We won't spend too much time on that. I would encourage you to just go read the definition so that you can fully understand the difference between them. All right. So in this situation, under the perpetual inventory system, we would debit inventory and credit accounts payable. We kind of already talked about that. The funny thing to notice here is under the periodic inventory system, we debit purchases. Okay, like I said, most people don't use the periodic inventory system anymore, but just the thing that I really want to highlight is they literally do not touch the inventory account until the end of the period when they do their physical count or whatever it is. So all of their things where we would put it to inventory under perpetual, they're going to put it somewhere else. It's going to be under purchases, under just different things. All right, so they're not actually going to touch the inventory account until the end of the period. Straightforward, okay? She purchased some things on account. All right, on March 2nd, she received and paid $100 for this this stuff that was shipped to her. So she is going to treat this as a part of her inventory. So she's going to increase her inventory by that $100 as opposed to expensing it. All right. And once again, in the periodic inventory system, they're doing their own thing. They're going to debit an account called freight in. All right. Once again, not going to spend too much time on that. I do want to just touch on it just in case you are using a periodic system. If you have questions, you know what to do. Send me an email. All right, on March 6th, that's my mommy's birthday, she received a credit memo for the return of $500 of the goods, which had arrived damaged. So basically, Miss Yin received $500 of those goods. They were damaged, so she had to send them back. All right, so the credit memo basically says, oh, here's your money back. Here's what we're gonna return it, or you don't have to pay us for that portion of it. So literally, all she does is reverse that original purchase entry. So she's going to debit accounts payable this time, reversing it, and credit inventory to bring our inventory back down to a new amount, to $1,500 now. All right. In the periodic system, she's debiting accounts payable. She is reversing that. But once again, we don't touch inventory. So they're going to credit an account called purchase, returns, and allowances. All right, what they're going to do is they're going to reconcile all of these accounts and eventually put it into their inventory account at the end of the period. But so that is what they're on track to do. All right, entry number 4. So Miss Yin does go ahead and pay ABC for the amount due, which is the $1,500. Remember, they gave her 210 net 30. The 10th is within 10 days. So she's going to take advantage of that discount. Therefore, she is going to debit accounts payable. Remember, you always have to completely empty your accounts payable or accounts receivable account, whether you're selling or purchasing it. You have to completely empty. That's how you're always going to get one part of this journal entry right. Accounts payable, accounts receivable always has to be for the full amount due. You have to empty that out. All right. So she's not going to pay cash for the full amount, but she's actually going to take advantage of that 10%, 2% discount. All right. And so she is going to have a credit to inventory. And I'm looking at these numbers and not thinking that they're right. $30 is 2%. Whew. Professor Nance is nervous over here. Okay, that's what I think. All right, so that is 2%. She's going to credit inventory for the discount amount, and then she's going to credit the rest of it to cash. So that's the other 98% that she's actually having to pay. The other part of that under periodic is that she's going to debit accounts payable once again for the full amount due, and then she's going to credit purchase discounts, which we don't have that on periodic perpetual system, and then cash for the rest of it. All right, number 5, on March 15th, she sold, we're selling some inventory now. She sold merchandise inventory on account to Miss Kim Fox for $500. The cost of the inventory was $300. Now, this is very important. Anytime that you are selling something, remember, there's going to be a 2-part journal entry associated with this. So you have to know the cost and what you sold it for. You have to know both of those numbers, okay? If they don't give you both of those numbers, there's probably a way you can figure that out, right? They'll tell you how many units you sold. Well, you know how much it costs per unit, so you can figure it out. But either way, you have to have both parts of the journal entry. All right, so in this situation, under perpetual, we're going to debit accounts receivable because they owe us this money. Kim is going to pay us this later. You're going to credit sales. That is for the sales portion of the sales portion. And then we're going to debit cost of goods sold and credit inventory for the cost portion of this journal entry. Remember, 2 parts. Always have to have 2 parts. All right. And then under periodic, we only do the sales portion because once again, inventory will be taken into consideration later. All right. Number 6, we paid crisscross shipping, $10 to deliver the cost of goods sold on March 15th. Easy peasy. This is going to be an expense. All right. Delivery expense, cash, both periodic and perpetual. All right. On March 17th, Kim returned $100 of the goods on March 15th because we sent them the wrong merchandise. First of all, if you have a lot of these returns, this is not good for business. So you want to look at this and you want to figure out why you keep having these returns. If you're continuously shipping people the wrong stuff, you want to look into that. Why are you sending people the wrong stuff? Is there somebody in your shipping department that needs to be reassigned? Figure it out. This is not good. However, it is really good for this example. Okay, so in this case, for the perpetual side, you're going to switch. You're just going to do the opposite of all of the journal entry all of the journal entry that we did to sell it originally. The only difference is instead of debiting sales, we're going to debit an account called sales returns and allowances. All right, we're going to see that show up again, but we're not going to just take it back out of sales, because we want to be able to look at our sales number at some point throughout the year and see what we really did sell, even if it was returned. All right. And then in periodic, we do that first part of the sale portion, but not the cost portion. All right. On March 24th, we received the amount due from Kim. So in this situation, she once again did take full advantage of that discount. And so remember, we are completely emptying out the accounts receivable account. That is our credit. All right. And then the debit is split between cash and the sales discount. Remember, you're looking to see if she paid this within 10 days. In this case, she did. So she is taking full advantage of that discount. Periodic, the journal entry looks exactly the same because there's no inventory involved. Okay. All right, and then that's it for all the journal entries. The only last thing is just to look at this on the income statement. Remember, we usually had revenue minus expenses equal net income, but now we have net sales minus the cost of goods sold, which is exactly what it says. It is the cost of the goods that we sold. And that gives us our gross profit. That tells us basically before any other expenses, how much money did we make on this little item that we sold. All right. So to arrive at net sales, you're going to take your gross sales. That's the total in your sales account minus any sales returns and allowances, minus sales discounts. And that gets you to net sales. All right, friends, that is it. So we just learned a lot about merchandising inventory. So let's go ahead and get out of here because I am hot and I hope that you are too. All right. As always, if you have any questions, comments, concerns, please let me know in the comment section below. Also, if you get a chance, go check out Miss Yin's Yangs. I mean, you might see something that you like, and she's going to get some new inventory soon. All right, so let's go ahead and get in our stance and let's do our dance. It's time to get out of here. See you later. Bye.